Where we go. Once upon a time, not long ago. No?
It says live on there we go.
Mine says setting up your meeting,
Nope, it says
redirecting to Facebook
it's there.
Live.
I see it, but I don't think I can share it.
Maybe you have to, I don't know, can you share a live feed or do you have to wait until the live video posts and share it after?
Maybe that's it.
So
Okay, so anyway, hi.
Hi, everybody. Welcome to 2021. I'm Rachel Evers.
Started great. I'm Cassandra Evers.
Yes, and this is our inaugural episode on our Facebook page, which I guess we'll see how this goes. It's going to be the same game, same content, just putting it in a neutral space so that it's more easily accessible and we can kind of see what you guys like and don't like. So we'll be able to tweak and see insights into what's happening with our content. So hopefully it'll allow us to do a better job for you.
Yeah.
Let's see. So we did Happy New Year. Welcome to 2021. And our usual disclaimer is we are about to talk about all kinds of real estate stuff. And I am a real estate professional. I'm actually a broker in Southeast Michigan. And I'm going to give you all kinds of advice and opinions that may sound like legal advice and financial advice. And it is neither of those things. I am not an attorney. I am not a financial professional. I am a real estate professional. And yeah, everything I say to you is my opinion. That is my cover your ass statement. Cassandra?
I'm a licensed loan originator in the state of Michigan. What I say may sound like financial advisor advice or perhaps legal advice. It's neither of those things.
Oh, you can share to a group or to a page. Sorry, I was dicking around. Nice. Okay, so today we have, I feel like I say this a lot. All of our topics sound kind of boring, but none of them really are. Because on paper, it's very dry, right? We're going to talk about discount points and appraisals. But boy, when you're in the thick of a transaction, they both get really vibrant and interesting and important, at least for the moment that they need to be handled. And my topic, which the one I chose for today, which is appraisals, is actually a Cassandra's department thing to handle. But I had such a detailed conversation with a client on a deal I'm in the process with right now that I thought, boy, maybe it makes sense to really hammer through this from a real estate perspective. So I'd like to do that. And then Cassandra, with tax time coming up, wants to talk about discount points, which, I feel like we've talked about, but you can never explain it enough, right?
Yeah. And I had somebody reach out who purchased a home last year and asked about discount points. He watches the show. And so I texted him and he said, you should talk about that on your show. And I was like, perfect, no problem. So,
and for whatever it's worth, if there's something that you'd like to see us tackle, put it in the comments or message Cassandra and I. We are both such somewhat insufferable know-it-alls that we love explaining things. Private message available. You can text me. You can send me smoke signals, mail me a letter. I don't care. If you got something to say, bring it, because I'm happy to try.
Yeah. So can I start? Because I'm just going to try to keep it quick. Discount points.
Never keep it quick.
Okay. Discount points are money that you pay at closing on your house when you get the keys, and you pay that to the lender in exchange for a lower interest rate. Those discount points that you pay, the dollar amount, can be a tax deduction. And I will issue a little caveat in that once the structure of the line item standard deduction changed in like 2018, most people cannot itemize their taxes. So discount points perhaps may not be a write-off. However, if it's an investment property or you have more complex taxes and you do itemize, it's absolutely a deduction. There are other deductions related to owning real estate, but I'm talking about discount points specifically, and those would be in box A of the loan estimate or box A of the closing disclosure. And if you bought a house in the last year or refinanced, ask the person who helped you with your loan for a copy of your closing disclosure, and you can see if you paid discount points. It will also be on your mortgage statement that the mortgage company sends you at the end of the year.
So what is this, and I know you're not a tax professional, but is this considered interest? So it would go with my mortgage interest that is tax deductible, or historically would be if I were not taking the standard deduction.
Yes,
Discount points count.
It's prepaid interest. It's a dollar amount. It's basically you're paying interest up front in exchange for a lower interest rate for the term of the loan.
And just to be clear, lower interest rate than my free rate, right?
Yes, then the free rate. Remember, you can pick your interest rate. There's a bottom and then there's a top.
Yep.
And most people, I personally choose the free one, the one that you don't have to pay money to get, and the one which is called a discount point, or the one that you can get a credit to lower your overall cost if you take. So discount points are any amount you pay to get that lower rate.
So it's one of those fees that is a tax write-off, really,
yes.
right? Like,
yes, and sometimes
okay.
people don't know they're paying them. Like I will plainly state that Quicken, Wells Fargo, a ton of lenders, literally, if you go to their advertised rate, way at the bottom, and I've said this before, in fine print, they're assuming you're going to pay 2 discount points, which is 2% of the loan. $300 loan, you're paying 6,000 discount points for that advertised rate, or $6,000 for that advertised rate.
I think that this part of this topic bears walking through again, because it is, and we don't have to beat a dead horse too much, but so many times my clients will come to me with a loan officer in tow, and I'm not in the business of, like, I don't care who you borrow your money from. That's my position.
You're not in the business of steering people.
Exactly. But I also have a fiduciary obligation to my client. Like, I have the role of a fiduciary. So, I stay in my lane. I'm not a loan officer, but I have often gotten to the closing table with my buyer client, and I get to see the fees on the settlement sheet. And I'm just like, are you effing kidding me right now? Some of the VA lenders, and I'm a huge fan of a VA loan, like
USAA, Veterans United.
So I'm not going to name names, but I can tell you that some of the best marketed VA lenders who pull on the heartstrings and play this patriot card and then fuck over our vets so hard at closing. I'm like, like whatever benefit you were getting by getting a VA loan is more than usurped by the fees you're paying up front. Not because you're getting a VA loan, but because you're getting it from this guy. And I got this guy over here, or girl, who can kill it on that loan and not rape you on the fees.
Yeah.
And I'm getting a little bit heated, and one of my goals is to
I deal with this
so freaking bent out of shape. Yeah, but I think it comes from just people not knowing, and it's so overwhelming already. Listen, I do this every day. So I take care of so many loose threads. I know which ones to take care of, and it's overwhelming for me sometimes. So now let me imagine I haven't done this in 7 to 10 years. And I only do it one time, and it's a little bit different every time, and my goals are different every time. I can see how easy it is to screw somebody over.
Can I just say,
yes,
if you're shopping for a mortgage, look at this. Box A.
I love it.
Box A will tell you the difference between me and Quicken and Veterans United. Like, that box is the cost that really, it's the summary of everything else is basically going to be the same. Box B, it's not going to differ wildly.
No.
But box A is directly related to the lender and the interest rate that you're getting. And that's really important to know. And if you're buying a house, I'll take a look at it for free. I'll be like, yes, that's a good deal.
Well, and I don't know if you have it handy, or maybe we put this in a different episode, but other things that people may or may not realize, because I've seen clients get tripped up here too. Again, not a mortgage professional, but if lender A says you're closing, let's say closing costs, and we did a whole episode about what that language means, but for the sake of this conversation, let's pretend that they're the same thing across the board for all definitions. Lender A says your closing costs are going to be $2,000. Lender B says your closing costs are going to be $4,500. That, to a client's eye, who doesn't know how to look at what they're looking at, nor should they, because they don't do this every day, to the client's eye, all other things being equal, lender A has the better product. So they're going to go through the process and get to closing and then find out that lender B was being honest about estimates for taxes and title insurance, where lender A may
short them all,
underreport those numbers, or new loan officer doesn't even know that, you know, taxes in Macomb are going to be very different than taxes in Livingston or town to town. And these are other boxes. This is different from what Cassandra's talking about, box A. This is, if you're trying to do a side-by-side loan comparison, you might want to make sure and pick your own fucking number to put in to the tax estimates, because that's just you. Let me say something. No, hold on. Okay, but let me get to my point, because the reason I say that is the tax estimate is you paying your own taxes. It is not a fee from the lender. So if Cassandra says the tax estimate's $100 a month and the other loan officer says the tax estimate is $400 a month, those are just estimates. Like they got a placeholder in there.
So again, this is, so you can total the closing costs in terms of a dollar amount, right?
Yeah.
Everybody can do that. The difference between 2,000 and 4,500, the difference, everything could be the same, but somebody estimated taxes wrong. You're right. So just remember that no matter who you go with, the difference between everything from box B through L is going to be all within $100, literally, because the escrow setup, the first year's homeowners
it should be if the loan officers estimate, like actually paying attention to the boxes.
So here's the thing, when they get to the closing table,
at closing,
so between box B and L,
start over, because
I didn't even finish.
No, I know, but you're going to get to the end and then I'm going to make you start over again.
What I say, box A is where the majority of the difference lies. 99% of the
I understand, but you're talking at closing. So if a client is out shopping around, they're going to see differences in all the other boxes. So I guess
telling them to ignore it.
Yes. Well, understand that by the time you get to closing, the amount you pay for all the other boxes will shake out to be the same figure, because they are actual prorated taxes. It is the actual cost of a title insurance policy for your lender. Those are the same no matter what.
Yes.
That box A is the lender fees, the cost, like the overlay, the fee we charge to do all the shit for you.
Yes.
Yeah, because in your industry, you don't make a dime if I don't close on the loan. So you could work on my file for 6 months, help me get my credit score. I find a house, we do the inspection, we do the appraisal. I give you all my documents. You're paying an underwriter and a processor. And the day before closing, I go buy a new car. Guess who just worked for 6 months for free? Or I got fired from my job, or, whatever, shit happens. And that's a little bit beside the point, but that box A
is the
cost.
B. Box A is 99% of the difference. Box B might be a couple $100. C through L are going to be basically the same. So when you're shopping lenders, look at box A and B, total those, and look at your rate.
And they will, all the rest of the boxes will end up the same.
Yes,
because they are fixed costs that are estimated on the front end, because a lot of them can't be determined until you get to closing. Because the tax proration can't be figured out until you know the day you're closing.
Yes, and the taxes are going to be the same. The homeowners is going to be the same regardless of the lender. So if I'm shopping for a house, I'm going to ignore boxes C through L on all of my documents.
Yeah.
Because whether you go with me or the credit union, right? Or
by the time you get to closing,
you call Loan Depot or Guaranteed Rate, by the time
you borrow the money from Rachel.
Borrow the money from Rachel. Everything in box, C might be a little different depending on the title company. D is going to be the same. E, F, G. like they all shake out.
So let me ask
Ones
you a
that don't
question.
are A and B very slightly.
Is A where the discount points
Yes.
would be charged? Aha.
Discount points, origination fee, lender credits. Yes, box
Okay.
A is everything relating to what that lender's charging you for the services, origination, or what you might be paying in discount points. Sometimes there's a lender credit to offset that, so you'll want to look for that.
Yep.
Like, maybe lower that amount, but
and those have to be like, there are guidelines, right? Like sometimes it might make sense and be better for the client to charge X and then credit back Y instead of just charging a different amount out the gate.
Yes,
regulations
I do that a
behind
lot.
that.
Yes, I do that a lot. So if you see in one of mine, a box A, a charge of $2,500, there's a pretty damn good chance you're going to see a lender credit for $2,700. So I've wiped out my charge and giving you an extra $200 or something.
So, I mean, a little bit of a rabbit trail, but in that scenario, what's an example of a reason why you wouldn't just give me a $200 credit? Why do you charge me 25 so you can credit me 27?
It has to do with legally as a mortgage broker. So I'm a mortgage broker. Legally as a mortgage broker.
I love this. This is important.
Okay. As a mortgage broker, I am held to a standard that a bank is not. I have education that bank loan officers don't have. I mean,
and it shows when I have to do closings with banks, I just want to throw up.
So as a broker, I legally have to give every borrower every bit of credit for the interest rate if there's one there. If it's $1 credit, if it's $4,000 for the rate, right? So not every lender, like I could pick a rate of 2.321 for somebody. I can get that specific, but not every lender will do that, right? There's only a few lenders that will. So if I'm stuck between 2.5 and 2.375 on the rate, if I choose 2.375, it might be $100 charge. If I pick 2.5, it might be a $700 credit. So I have to talk with the borrower and go, do you want to pay a little bit to save $7 a month, or do you want to save $700 at closing? Or you know what I mean? Like
it's a sliding scale.
Yes.
As one goes up, the other goes down, and you kind of got to pick where you're going to land.
Yes. Yeah, because you can pick your rate. Again, you can pick your rate, and if you go to a mortgage broker, we have to give you everything back. If you went to a bank and there was a credit, like an extra, you know what I mean? Like there was more money to be made in giving you a rate of 2.5, the bank can fucking keep that. You never know. Like you don't get that credit back. Like legally they keep it. They go, sweet, let's give them a rate of 3% and we'll keep it. We'll keep the extra.
Example? Why not give a hypothetical example for my bank, Rachel's bank? Can you give that example? Can you do the example with my hypothetical Rachel's banking?
I know for a fact there is a bank that
Rachel's bank. It's Rachel's bank.
Rachel's bank.
I'm really ripper offered.
Okay, prices loans at 104, right? So, oh God, I don't know how, I'm going to get into basis points. I don't want to confuse people. Anyway, the rate that they would give people was a 4% profit for them. They got paid.
So I get paid what? So it's like I'm getting spiffed on the back end from the guy I'm getting the money from.
Yes.
This guy.
A higher rate, so I get paid more. And as a broker, I can't do that.
Right.
So
I can be like, okay, so as the bank, at Rachel's bank, I can be like, hey, this guy with this bucket of money who's actually funding these mortgages is like, hey, if you take money out of our bucket at 3%, I'll pay you an extra $2,000 from the other bucket. And so I'm over here like, you know what this is? This is when I used to work at Verizon and they really wanted us to push BlackBerries. So I would get paid more on my paycheck if I could talk you into thinking you needed a BlackBerry.
Yes.
It's a spiff.
So a lender can get paid more for selling it at a higher rate.
Yes.
Right? And they don't have to give you the credit. As a broker, I have to pass along, and that's why I say,
why the difference? Why the difference in regulatory guidelines?
Okay, so from what I understand, I wasn't a lender then. From what I understand, back in 2006, 2008, brokers took the majority of the fall for the housing crisis. They were selling loans that
Because the
everybody
banks
was
can't
buying.
fail.
The banks were all bailed out. Mortgage brokers plummeted, even though we're
Yeah.
talking amazing. But anyway, so from what I understand, mortgage brokers came under this intense cloud of scrutiny and severe regulation because they thought we were at fault, mortgage brokers, for the entire decline. Mind you, the federal government bailed out like almost every single day.
Yeah.
Well, and they were giving the same loans, but they
and not, yes. Well, and not to give a free pass to anybody, but hindsight always being 2020, everybody who was in that business, including the people getting the mortgages, were just playing by the rules that they were told to play by. So here's the game, here's the rules. People were maximizing the rules, and we all did it to ourselves.
Right. I mean, just as there were people who signed off on, you've seen, what is the movie?
Big Short.
Yeah,
Big Short.
Big Short, where, you know, they're going to a stripper and she's like, she's buying her 7th house on stated income. My first house, I stated my income. I told them how much I made as a servant. I didn't lie, but like people did.
My bad ex-husband did a cash out refi or a refi with an out-of-state lender. Like it was so fucking shady because I had already been through a few houses with my first husband. This is way too much personal information, but my bad ex just like paid an ass ton of money to borrow an insane amount of money on a house that I knew he couldn't afford because he never worked. That motherfucker never worked.
And they gave him the loan.
Oh yeah, totally. Yeah. Without me signing anything. And there were dower rights then. I was like, don't I have to sign something?
Have to sign anything?
No, it was so fraudulent and shady. It was, yeah, and I wasn't in this industry, so I only knew that it smelled funny, but it also wasn't my problem because I was like, in the back of my mind, I knew shit was bad in that marriage. So I was like, well, if I'm not on that loan, then that can't touch me.
Good for me. Yeah.
Which is not entirely true. So please don't take me saying that as though it's true. It's not. Like I still ended up on the hook, and that's for a different episode. Maybe we'll go have a beer and talk about that one someday.
Texas fucking you over.
So back to box 1, the cost of doing business with the lender, which is what people are really shopping for when they think they're shopping a rate. They're actually looking for how much does it cost me to buy the same product from you compared to my bank or I almost said 123 Main Street. That's a real estate. What do you guys do in lending world? Do you call it like Rachel's Bank? You should.
We don't do anything like that.
You don't have that hypothetical property, that hypothetical.
No.
Oh, okay. So box A. Hey, can I see box A while I'm lender shopping? What I think I'm doing is rate shopping, but actually if I'm always talking about my free rate, then I'm just fee shopping.
Yes, and you can also ask specifically. So sometimes people give a fees worksheet, which I give often. It's literally the top thing it's at the very top, and it will say discount points.
At the very top of what?
A fees worksheet. Okay.
Oh,
I don't want to rabbit trail. A loan estimate is given basically when you're under contract and you've made application. A fees worksheet is a good estimate, but they can kind of be interchangeable, but the requirements for a loan estimate being given are a little bit higher. So oftentimes I'll just do a quick fees worksheet if people don't have a specific property address or aren't under contract.
Okay.
Because frankly,
so you're giving them
loan estimates kind of a pain in the ass, but.
Yeah, and you're giving them what they're really looking for, which is like they're shopping you, as they should.
Yes.
Right. Like sure.
They should.
This is what I charge, and if that doesn't suit you, then okay, great.
Yes, I had an engineer who was referred to me for a refinance from another engineer. And I said, this is your rate. So I gave him like 2.036, right? Very specific. It was the 0 whatever rate. And I said, you're an engineer. You like things very cut and dry. So this is your exact rate. And this is my charge, right? And you know what I mean? And so everything was line items. Personally, I think everything should be that way.
It makes it easier to, it makes it too
Yes.
easy to do a side by side. It would be like standardizing
Oh, no.
mattresses.
Yeah,
It's just not
it makes
happening.
it would make it actually possible for people to shop
Shop.
for real instead of through the clouded,
Yes.
like I could go on any website and be like, okay, their rate is going to be 2.375 for me without looking at the 2 discount points, a 25% down payment requirement, 760
Credit
score
score.
requirement, all that stuff. Yeah.
Mhm.
But if we literally had to price everybody at a zero, right? At like this is what you qualify for rate very specifically. And then these are my fees or these are the fees. That would be fucking great. But that's not how it is. Banks have
Yeah.
different rules. They can pack in a whole bunch of profit without disclosing how much profit they're making to you.
But
So
you can't.
I can't, right?
Well, it's important to know, at the front end so that you don't get the scary sticker shock at the back end, which I
Yeah.
mean, I closed a loan with this one sticks out in my head because it was the first time I saw a vet get like knocked on their ass by a fee. And I was like, what is this $6,000 fee? $6,000 single line item. I was like, what the
Origination,
F?
origination
Yeah.
fee.
Yeah. And I know that doesn't need to be there.
Nope.
So yeah. Discount
Not
points,
only
tax
that,
deduction.
there was a 1% origination charge, plus that bank made money on the back end and legally didn't have to disclose it. So I
Yeah,
guess
so
I would caution, if you're buying a house, check box A, and if you're using anybody but a broker, go to findamortgagebroker.com or text me. I know people in all 50 states to just get another quote. It's not going to hurt your credit score. You don't have to go with them, but man, is it important to just step outside of your local bank or one of the big lenders, because with big lenders come a lot of overhead and a lot of expenses, and that gets paid, and a lot of advertising, and that gets paid for somewhere.
Yeah. Yep.
Anyway, okay, so I'm done with discount points. I just want to touch it. They are a tax deduction if you itemize, and not many people do.
Yeah, so that's literally the only saving grace for that vet is this loan closed before the standard let me just say it.
But that's
I'm
not
trying
an option.
The $6,000. Oh, you're
That's
right.
an origination charge.
That's right. My bad.
Discount point.
Good. Thank you for stopping me. That's right. It's a lot of balls to keep in the air, and these are not my balls. These are your balls. That means two things. Anyway, I want to talk about appraisals. And so let's imagine that you are in a contract, you've done your shopping, you've looked at box A, you've got your lender, or you've got a bucket of cash and you decide you want an appraisal. The topic I want to address comes directly, as most of my topics do, out of a file I'm working on right now. And I realized yesterday on a call with a client, and I don't think I know how to address this without going really far into the rabbit trail of this specific file. So perhaps you can help me. Clients who are waiting on an appraisal have the impression that the appraisal is the value of the property. Like, how much is it worth? Wait for the appraisal and that'll tell you. The follow-up conversation to kind of nip that in the bud or expand the understanding is people often say the appraisal is one person's opinion of value. But in my conversation yesterday, I realized that the appraisal, the job of the appraiser is to answer a specific question, and that the appraisal itself is different depending on the question. And here's the scenario. I want to give the little nugget up front. The appraisal is not the value of the property. 9 times out of 10, the appraiser's job is to assess the lender's risk. So the buyer pays for an appraisal as part of their fee to access a mortgage. The guy lending the money is sending somebody out to say, how risky is it for me to lend this money? So let me give you a dumbed down scenario. Let's say Cassandra wants to borrow $300,000 from me, Rachel. And I'm like, okay, I'll loan it to you. And Cassandra's like, I want to buy at my neighbor's house right next door, and it's a 3-bedroom, 2-bath, and it has a pool, and it's a beautiful, like mid-century house with this wraparound deck and lots of windows and sliding glass doors. That's Cassandra's house, you guys.
That's my house.
That is.
I want to buy this house. Go
Yes,
on.
you do. You do.
I do.
So,
I do.
so you call me up and I'm your sister, and I'm like, you know what? That's great. Now, keep in mind, I live in Howell. Cassandra lives in Kalamazoo. I've not seen this house. She's telling me it exists, and on paper, it looks good. And let's say, so now my dumbed down scenario is I'm the lender, she's the buyer. I'm going to send our brother Ryan. I'm like, hey, Ryan, can you go drive by, make sure this house isn't a total piece of shit? Because I'm loaning Cassandra $300,000 to buy this fucking thing. And I just want to make sure that if Cassandra flakes out and doesn't pay me, that I will inherit an asset that is worth the $300,000 at least, so I can be made whole. I may not make any money, but at least I'll be made whole. Right? So if Cassandra performs, I'm making money. If Cassandra flakes out, it's going to cost me money to foreclose on her. That's the risk I'm willing to take. I can still sell the house at the end of the day. So our brother Ryan goes out there and he calls me up and he's like, Rachel, I mean, maybe in its heyday, this thing was worth $300,000, but all the houses around it are trashed and they have couches in their front yard. And it's really only got 1.5 bathrooms. Like, it doesn't shake out. I don't see $300,000 in value in that scenario. Ryan's opinion for sure is just one other opinion of value. But his job when he went out there was to just assess my risk. So he was looking through a specific filter. And it's important because what if I had asked Ryan to go out there and look at something else? What if, I feel like I'm getting a little bit tied up because there aren't that many what ifs in an appraisal scenario. But Ryan's assessment in this scenario that the house isn't worth $300,000, and if, let's say I said, well, put a number on it, and he came back at 250. So I come back to Cassandra, I say, I can't really take that risk at 300, but I'm willing to take it at 250 because I trust Ryan's opinion for whatever reason. He's licensed or whatever our relationship is. And here's where I'm getting a little bit stuck. So what would be another set of filters that I could send Ryan out there for? What if?
Asking me?
I am. I asked for your help at the beginning because.
Well, I don't know what you're getting at. Like,
well,
I know that there's something coming. I just don't know what it is.
Well, and I'm struggling to get there. So now let's set aside the Rachel, Cassandra, Ryan scenario and talk about my actual client scenario. I have a client buying a really weird property, and they are getting a mortgage for this property. And this property is so weird that the appraiser is having trouble with the appraisal. And there are some tax IDs that are not yet part of the title commitment. It's multiple properties in one purchase. So we've got like 7 tax IDs that are it's actually 6. There are 10 tax IDs in one purchase. So we've got 10 tax IDs being purchased. We have title work on 6 of those properties. And the appraiser, when he did his appraisal, did it on 6 of the properties because they are clearly defined because the title work is done. So these other 4 tax IDs that we don't have information on are not part of the appraisal yet. But we're far enough into this, there's months of work under our belts on this one deal. Buyer client is saying, well, is it even going to appraise? Because it's so weird. There's a big question. And if the property doesn't appraise for purchase price or higher, the deal can't go because the lender's not going to take the risk. So the appraiser's over there saying, well, I can't tell you what this property is going to appraise for because I have no idea what to do with these because they're not defined yet, because the title work isn't even started yet. So we are very much in a catch-22. Like, one guy's waiting on the next guy's waiting on the next guy, waiting on the next guy. And here's the thing. All we want to know is, all right, in this hypothetical situation, the purchase price is $150,000. So the $150,000, are we going to appraise around, if these 4 properties removed, if right now we're at 130, we might be in spitting distance to our 150. But if we're this far deep and the number's only shaken out at 60 or 70, it's very unlikely that we're going to recover that gap of another 70,000 or more to appraise at contract price. You know what I mean? So it's like taking your car to the mechanic and saying, like, am I looking at a $600 repair or a $6,000 repair? And the mechanic's like, well, I can't tell you that until somebody tells me what motor's in that car. You know, I don't know. Okay, so now you were gonna say something, so go ahead and say it. And then I'm gonna screen share because I found a beautiful definition of an appraisal that really hones in on why the appraisal is not the value of the property. It's a property can appraise for a price that's different from the sale price because the current right now value does not get established until the sale closes. And it's not the property's fault that you can't close without a mortgage and your lender is not willing to take the risk because the guy they sent out there doesn't see the value. Does that make sense?
Yes. So I had a few things there, but based on what you just said, I could list my house for $1 million. It means absolute shit. If my neighbor's selling their house, the appraiser can pull my listed house for $1 million and put it on. It means absolutely fucking nothing until it closes. So when you get an appraisal and the appraiser's trying to determine the risk, right? If your house is worth the risk of loaning that much money on, which is a combination of the value, the condition, the neighborhood, the comparable sales, whether it's increasing, decreasing.
And all of that is what the appraiser is looking for because he has a target in mind, which is your purchase contract. It changes the context.
Well, you can also order an appraisal, which is just market value, but I won't go to that.
But yes, you will, because hold on. I want to talk about that because it's not just market value. You can't know market value until you put your house on the market and sell it to somebody. You can get an appraisal. It's like, here's the dumb analogy that's going to illustrate my point. I'm selling this. Let's say I'm selling this. And anybody can go buy a pink hydro flask for $20. You can buy it on Amazon, $18.99 to $22. Let's say that's the price range. So we know this is around a $20 item. But let's say I'm selling this and I'm selling it for $99. And everybody's like, well, that's crazy. That's a $20 hydro flask. But what if there's gold in here? And I know it. And Cassandra knows it because somewhere on here is some code that she understands. And she comes along and says, I'll give you fucking $99 for that all day long. You buy it. We just established the value of this because it's unique and special. It's filled with gold. If the appraiser who comes out to look at this looks at all the other pink hydro flasks, they're going to say, that's a $20 item. I'm not backing that loan because they don't see the value the same way that the seller and the buyer do. And the market may reflect.
Right. The purpose of the appraiser is to help the lender determine
the risk.
If the risk is worth taking. That's it.
And
I will tell you, let me finish though. Yeah. I just had an appraisal come back. Appraisal was good. It was overvalued. There were no repairs required. Everything shakes out. However, when it goes through the computer system, the underwriter runs, it comes back with a score. The score was high, it was out of bounds, which means it has to go for a review.
Talk about that. What is a high score? What does that mean? That means it's like
I'm not going down that rabbit hole. It just means that the system where all of the appraisals are housed, right? Sees all the adjustments the appraiser made to find the value on the similar.
It's an assessment of the appraisal and to prevent a guy from just filling in whatever he wants.
Right, from getting $500 and being like, what do you need this to appraise at? Great, I'll pick houses and adjust them crazy.
Or even just half-assing it, right? Because there are people who do their job poorly in every industry. So there's an appraiser out there who's just dialing it in. He's like, okay, this needs to say 300,000. Bloop, 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 done.
I just want to clarify that many people think the appraiser is the end all be all. The appraiser is not. The appraiser puts in a report. It is reviewed by an appraisal management company where sometimes there are repairs or requests that need to happen. And then it's also run through an automated system to validate the risk score. And if the appraiser's appraisal report is too far off, it will go for another level of review. That doesn't mean it's wrong. It just means that, like,
No.
if a market has changed rapidly, you're going to get something like that where you go, what?
Yes, and we're seeing a lot of appraisals lagging because appraisals look backwards and purchases look right now and forward. The oldest and most trotted out story of my entire career, and hilariously, I used to eye roll when agents would do this, but now I know why they did it. Very first house I sold, appraised at like a contract. I don't remember the exact details, but I do remember that we had 2 appraisals on the same property within 2 weeks, and the values came back $50,000 apart. So this appraiser saw, with the same purchase contract, this appraiser saw $127,000 in value, and this appraiser saw $157,500 or something in value on this, or 170. It was actually 178 and some change. But 2 different guys, 2 weeks apart. Market didn't change that much. Maybe they were girls. I'm not trying to be sexist here. $50,000 difference. So the appraisal is not a stamp that you can say that's what it's worth. It's literally, in the case of a mortgage, a mechanism to determine the guy with the money's risk exposure.
Yes, and a lot of it comes down to the houses that are selected as comparable sales, right? What am I comparing this against? So like in my neighborhood, there you could throw a stone and find a fucking house that's kind of similar and be fine.
But is it designed by your architect?
No, and so actually, my house is going to be a little tricky to appraise if we go to sell it, just because the design is unlike anything in the neighborhood. There's lots of recent home sales in the neighborhood. There's not a lot of bi-level mid-century moderns. Matter of fact, I believe we're the only one. It's like they went, let's do the fucking crazy one.
So that could turn out,
you hate it, but
that could turn out to be the gold-filled $20 bottle.
Yes. So I've seen houses in neighborhoods where the appraiser's like, this is kind of unique. I'm going to have to go a little further than normal.
Outside the neighborhood.
Yep, 17 miles. Even if there are homes like next door. I had one where the home next door had sold and the appraiser refused to use it because it was a ranch, and the other one was a bi-level. So the style of house sometimes matters.
Yep. There's and before we run out of time, I do want to share the thing, because it does, or I can just read it. No, let me share it. Give people something else to look at besides my face.
Let's give them something to look at.
I like your
face. Thank you.
That's good. Can you see my screen right here?
Yeah, yes.
I'm going to read it out loud. The purpose of an appraisal is the stated reason and scope of an appraisal assignment, i.e., which means, for example, to estimate a defined value of any real property interest, or to conduct an analysis or consulting assignment to real property decisions. So the appraiser's job depends on what the client asks for. And I just thought this did a really good job, because we all talk about appraisals as though it's a thing that exists to assign a value to a property. And I think it's just a little more nuanced than that.
It is a little bit more. I mean, that appraisal that just came back, it assigned a value to it. That's fine. It said it was fine and habitable. That's fine. However, upon further review, going through the process, they went, this score's messed up. We gotta just do a second look. Yep.
And not to get too rabbit traily, there are other elements depending on your loan type that become part of your appraisal. I feel like we did an episode about that, but I just got so into it with this client, trying to overcome like what they already thought the appraisal was doing.
Yes. Have you thought about omitting these 4 and just getting an appraisal on the 6, and then the buyer can purchase these?
Yeah, we have. Yep. No, there's another parcel actually that is uninsurable. So the whole file is a lot thicker than I let you to believe. So we're going through quiet title on that, and I'm learning a lot. Yeah, property descriptions and
I just finished my quiet title section in the real estate class.
Oh, thank you. So listen, can we talk? Okay, if you're still hanging in with us, you got to know we talked last year about Cassandra getting a real estate license and me getting a mortgage license. And Cassandra has started her real estate class. I literally have that on my notes to talk about real estate license. So she's doing it.
I'm about done with chapter 10 of 24, and I started a couple days ago, so I'm making some headway.
So
finish up the class and take the exam.
And if you, I mean, if anybody has been hanging us with us that long, I am not taking my loan officer licensing class until I'm done with, do you see these numbers behind me? This is what's left of my master's program. So class number 1 of 8 was this week. So as that counts down, I'll be done by the end of February. And then I can, you know, start getting another certification, which will be my loan officer licensing, which I'm terrified of, but.
You should be.
I am, but it'll make me better with numbers.
I don't plan to use my realtor license. I just want to say that out loud. I just want to.
I don't know why you wouldn't.
Have the side bet.
Vote in the comments below. She should fucking use it. Why not?
I'm gonna use it.
Just don't use it on the files that you're doing the loan for. Why would you not use it?
I don't know. It seems wrong. It's, you know why? Because it seems like double dipping, and it feels wrong.
Just don't do real estate on the files that you're doing the lending on. I'll do those loans.
It seems clouded. It seems like my realtor partners won't appreciate it. It just seems like I'm muddying the waters. I'm getting it.
Dude,
that's because we had a bet.
In all seriousness, you make a very good point, and it becomes, in some ways though, getting that license will make you a better loan officer.
Absolutely.
It could also make you more insufferable to your realtors, because you'll be like, don't you remember? Don't you remember the meets and bounds description?
Yeah, I just finished that not long ago too.
Yeah.
But I was going to say, I know why you got your broker license in renewing the difference between a real estate salesperson, a broker, and an associate broker. Like the difference between them I assume it had to do with advertising and the strict requirements of advertising as a broker versus a real estate.
I have to advertise as a real estate salesperson because I hold my broker's license under another brokerage. Yes. It's got nothing to do with that. I did it because
cover that nuance then.
Oh, yeah. If your license is held by a broker, then you have to advertise under those guidelines as a salesperson. I got my broker's license because I like to learn shit and know shit. And I was taking the Con Ed anyway, so I might as well take the Con Ed for the designation.
Add the other 90 hours of education.
Mm-hmm. And higher fees, like everything costs more once you have a broker's license. But I mean, if I ever just wanted to, I like having options. It bought me options. If I want to just walk away and start Rachel's real estate, I could do that anytime. Like right now, if I wanted to. I love my brokerage, but if I ever don't, I can do whatever the fuck I want.
Fair enough.
That's my goal in life. Anyway, peace out, Girl Scouts. We will see you next week. And I think we're going to work on building out a topics calendar. But if you have any ideas, post them in the comments. Yay.
Okay.
Oh, yeah, more. Oh, yeah. How do we do that? This way? We should open every show with this.
Yeah.
It's one of my favorites. All right, I'll grab that screenshot. Thanks. Bye, Cassandra.
Bye, Rachel.